Jay, it's great to see you. So I guess just your reaction to what we're seeing play out today, what we have seen play out so far this quarter, and what that signals is ahead in 2023.
Thanks, Seana, for having me on again. What I think is really dominating the market right now is not a Santa Claus rally, but really a global bond sell-off, which started really with the ECB, but was exacerbated by the Bank of Japan. So we're hoping that rise in rates stalls out somewhere in the 4% level, and then that could set us up for a better price action into the end of the year and the beginning of next week.
Hey, Jay, Pras, so you think that we hit that bond market low here? You think that's what's happening right now? We're bottoming out right now, and then possibly 2023, you can kind of see a little bit of a liftoff there?
Yes, Pras, that's our thesis, is that you had mentioned, by the way, housing prices yesterday. That's really why we're very optimistic about inflation being below what the Fed is forecasting, because housing prices predict the change in shelter in CPI with a 6 to 12 month lag. And those have rolled over. We have our own index. It went negative. Our own CPI real-time index, it went negative 3 months ago. So we think you need to have inflation coming down to get that bond market rally. And bond prices are not just important to fixed income, but also equities. And that's really why tech stocks are weak today, and really why stocks have done so terribly this year.
So, Jay, what does all this mean then, just in terms of Fed policy, how restrictive the Fed is likely going to be next year, and what this all means just in terms of the odds of a recession? Is there still a chance that the U.S. could avoid a recession?
We think so, Seana. We're more optimistic than most because we've studied the last 11 recessions, except for the pandemic. They're all caused by tight monetary policy, raising mortgage rates, and then crushing the housing market. Particularly in 07, 08, obviously, we were building 4.5 million homes a year. Now we're building about 1.4. The reason we're optimistic that we might have a technical recession would be very mild. So we don't think we're going to get mass layoffs in these interest-sensitive sectors, really because of the pandemic and also post-financial crisis. So, but that's a sector to watch. But just last week, the new homes sold was 10% above expected. So it doesn't seem like the housing sector is crashing, but that's what we should watch, particularly in the first 6 months, because that's normally a weak time for economic growth anyway, as measured by the Commerce Department. So we think there's going to be a slowdown for 6 months, but then we could get a big rally towards the end of the year, even in the riskier tech stocks.
Hey, Jay, so looking ahead for 2023, based on what you just said right now and the Fed's sort of tightening cycle, what do you like next year? And is there even a play even in like real estate, for instance?
Well, we think so. We would still be defensive, particularly in the first 6 months. Preferred stocks is really our number one pick. Those are particularly of the ones that are $25 preferred, so they're traded on the stock exchange, so they're easy for individual investors to access. They're issued by public companies. And if you look at their 30-year default rates, they're about 0.3%, which is higher than investment-grade bonds, but high-yield bonds are 4%, so just 10%, less than 10% of high-yield bond default rates. So good credits, and that are very depressed. They're down about over 20% this year. So that's our number one pick. REITs, we think, if we're correct about inflation and rates coming down, REITs will also do well, particularly the pandemic recovery type REITs, retail REITs, even some high quality offices. So that's what we think, particularly for the 6 months, could work. And then if we do have a major rally, then the higher beta stocks could be appropriate in the second half.